My name is Thomas Scherlo. I'm the CEO and founder of Capitalmarket.events. And today I will be your host and moderate you through the web conference. While our first web conference was about Asia, we now turn to the second economic hotspot, the US economy and US stock markets. America has elected a new president. Twitter diplomacy has come to an end, obviously. But looking forward, there are many questions. How quickly will the US economy recover from COVID-19? What about the US-China trade conflict? How will the fiscal stimulus package affect the US economy? 2020, we have seen an enormous run of US technology stocks and value stocks and growth stocks. Will this continue in 2021? A lot of questions, and it's time to discuss US stocks today. And here's the agenda for today's web conference. Again, we have three fantastic speakers and a great lineup of expert portfolio managers. It's purely US equity topics today. Again, each presentation will be 25 minutes long. After each presentation, there will be 5 minutes of time for your questions. So feel free to push the Q&A button on the bottom of the Zoom window and type your questions, and I will ask them on your behalf after the presentation. Again, we will send around the presentations, the presentation links, as well as a recording link after the web conference. We will also send you the link to our quick survey, so please help us rate the web conference and the presentation. This helps us to make the web conferences even better for you. So without further ado, let's come to the presentations. Our first speaker is Jim Tierney. He's the Chief Investment Officer, Concentrated US Growth from Alliance Bernstein. Jim has more than 30 years of experience in international asset management, and the strategy he and his team is managing has been around since 1975, and they are managing 1.1 billion US dollar in it. What's even more interesting about their strategy is it's highly concentrated. It's only 15 to 20 stocks. So this is anything else but index picking. It's pure stock picking what those guys do. So I'm looking forward to Jim's insight and his presentation. So Jim, the stage is yours.
Wonderful. Thank you, Thomas. And thank you to everybody joining us this afternoon. Really appreciate your time. It could not be a more interesting time to be an investor in the United States. There's just so much going on. I'm going to lay a little bit of the groundwork for the day in terms of the macro outlook and some of the things that we're seeing, and certainly get into what we do. So if we turn to the next slide, probably the most controversial thing that I will say today is that by June 30th or July 4th weekend, essentially everyone in the United States that wants a vaccination or a vaccine shot will be able to have one. That is because the 30 million vaccines that are going to be delivered by June 30th will more than cover the 330 million people in our country, given that those that are younger are not going to get it, and there'll be a natural group of people that opt out and just never get a vaccine. So when we think about the reopening of the US economy, it is way closer than people think. I know a lot of the skeptics say the economy won't reopen until the fourth quarter or 2022. What I'm saying today is it is coming very soon, and it's just months away. We looked at some data today from Bank of America that talked about card spending, credit card and debit card spending. It shows that when the economy reopens, and California reopened to a degree in the last week, people are going out and spending. So we're really excited about what's going to happen in the US economy and ultimately what that means for individual stocks. Talking about the economy, we have very easy compares. We have unbelievable pent-up demand. We will get back to normal in the second half. And we have somewhere between a 5 to 7% expectation for US GDP in 2021. Just a great number. You then turn to fiscal policy. And clearly President Biden's win, but very importantly, the 2 Georgia Senate seats that went to the Democrats were critical in being able to push more stimulus toward the US economy. The current Democrat plan is for an additional $1.9 trillion of stimulus. That is close to 10% of US GDP. So the pedal is all the way down on fiscal stimulus. We can talk about whether that might overheat the market, which is certainly a risk, but there'll be plenty of economic support. And then on the monetary side, Chairman Powell has said over and over that he's not even thinking about raising rates. So you put all that together and we see a very, very robust economy and an attractive investment environment. So our central case is a very strong economy in 2021. Rates are going to creep up, and that certainly has some implications for growth stocks versus value stocks, and particularly the very high valuations of some sectors. The Fed is going to remain on pause, and our guess is that all in, the US dollar probably remains about where it is, maybe weakens a little bit. In terms of what could be better than expected, certainly the reemergence of free trade. President Trump, with his policies, really shut down free trade in many corridors. The reemergence of that could be a nice positive. And VIX, which has been above 20 for a long time now, pretty much the last year, as that falls back to more normal levels, maybe the 15 level, maybe even lower, that can further drive equity valuations. What keeps me up at night? What do I worry about? Certainly virus mutations. And the Johnson & Johnson CEO was just talking this week about mutations and maybe your COVID vaccine being an annual shot or a booster. If the market has a taper tantrum, and certainly with rates going up, that could happen. But the biggest thing I'm really worried about is the cultural divide in the United States. And President Biden has a real job in front of him in terms of bringing the country back together. And I'll talk about that in a couple of minutes. So if we go to the next slide, let's talk about the market in 2020, which I really do think sets the stage for 2021. And this chart shows the performance of the 5 biggest stocks in the S&P 500 index last year: Microsoft, Apple, Amazon, Alphabet, and Facebook. From January through August of last year, they were the entire return of the market. On average, those 5 companies returned almost 51%. What did everything else do? The other 495 stocks in the index, they were down 1%. Since the end of September, the end of August, the beginning of September, we've had a complete reversal, with those 5 stocks down in absolute terms, not just relative terms, and everything else lifting up. And you look at the full year performance last year, what you ended up with is those 5 stocks being more than half the return of the index. That's a very, very narrow market. What we've seen since then is a broadening out of the market, and I think that has particular implications for stock pickers in a positive way. So let's turn to the next slide and dig a little bit deeper into the concentration of the market, because we've been here before. If I were to summarize this slide, it would be: trees don't grow to the sky. We've had periods of concentration. Here I'm using the Russell 1000 growth because the concentration is even more dramatic. But in past periods, April of 92, May of 01, May of 2012, we had the top 5 stocks in the Russell 1000 become very large parts of the market. This time around, in December of 20, we're at 34%. Rewinding the clock back to August, we were at 38 or 39%. What happens in each scenario? What happens is those stocks underperform in aggregate. You look at the boxes down below. If a name is highlighted in blue, it means it outperformed the index from that period forward. If it's in gray, it means it underperformed. And with only 4 of 15 instances outperforming, that's a terrible investment batting average. The lesson is you're better off somewhere else. And I think that the pushback to this is everybody says, but Jim, these are the biggest platform companies in the world. They're so dominant. Who's going to take them down? I'd point to three things. Number one, the regulatory front. And when you look at regulators around the world, they're all going after these companies from a anti-competitive perspective. Even China got into the act a couple of weeks ago. Secondly, you look from a financial perspective. With all the stimulus we've done, we have a great need for tax revenues, and that's true everywhere. You look at what the EU is doing with the digital tax. You look at what the US could do with the GILTI tax provision. These companies are big, they have tons of cash, they have tons of income, and they pay among the lowest tax rates in the world. So I think they will be a target over time. But the biggest deal is that they're just going head to head. They're competing against each other. And quite frankly, when you look at Microsoft and Amazon and Alphabet as the biggest cloud providers, at some point in time, they run out of room. When you look at Amazon and Alphabet and Facebook as the biggest advertisers in the world, as we model those companies out 5 years, they will be 75% of the global advertising market. When you're that big, you become the market. And that market only grows 4 or 5% a year, not the 20 or 30% that these companies are growing at. And you look at the very public spat between Apple and Facebook that has emerged. So I think competition, as they're beating each other up, means that returns in this space are going to lower. And I just think there are better opportunities elsewhere. So with that said, let's turn to the next slide. And let's talk about better opportunities elsewhere. And I think the world looked at COVID and looked at the global health pandemic as very black and white. Were you benefited by COVID, or did you have a COVID headwind? And those companies that had a benefit, like an Etsy or an Amazon or a Peloton, they went up a lot. And those that had headwinds, like the airlines or the cruise ships or movie studios, they went down a lot. But I think there's a more nuanced answer to this, which is there are some companies where you saw massive behavioral changes because of the long period, the 12 months that we've been in this pandemic for, that those changes are going to drive those businesses forward for years to come. And those are the kind of stocks that I really want to target, not just the recovery plays, but those where there's been a behavioral change. You look at Nike as an example. When people couldn't go to Foot Locker or couldn't go to Dick's, couldn't go to their local retail store to buy sneakers, they had to go to Nike.com. What has happened is Nike's direct-to-consumer business in the US has grown more than 100% in the most recent quarter. Why does that matter? Because when you go direct to Nike, their gross margins are 10 points higher, 10 full percentage points higher than going through the retail channel. That it means much greater profitability for Nike, and that's how people are going to shop going forward. Likewise, you look at MasterCard and almost everything that you bought, because you were buying far less in person, had to be done with a card as opposed to cash. Even my local pizza delivery guy, as you can see from my face, I saw him very frequently. He wouldn't take cash tips. You had to put everything on the card. And then the uptake in tap to pay. A technology that was rolling out relatively slowly in the US is now everywhere. So as we come out of this, card usage is going to be much higher. And when cross-border transactions and travel come back, MasterCard is going to be supercharged. Likewise, you look at Aptiv. One of the huge trends here is that the younger generation wanted to live in cities. After being locked down for 6 or 9 months, they said, I'm enough with the city. I'm going out to the suburbs. I want a home. So there's been a dramatic increase in home ownership. When you do that, you need a car because you can't walk as easily. Likewise, as we all go back to work over the next few months, how are you going to get to work? If you're afraid of mass transportation, again, you need your own car. So trends driving the global auto industry and Aptiv in particular. And then on a lighter note, one of the big trends during the pandemic was people adopting animals. And Zoetis, half their business is companion animals. So you're going to be giving your pet Zoetis medicines for the next decade or more. So very positive long-term opportunities for all of these companies. And I look across our whole portfolio, which I'll show you in a couple of minutes. I think there continue to be great opportunities. Turning to the next slide. I'd be remiss, though, to say that everything is wonderful in the US market, because there certainly are very large pockets of froth. You look at Bitcoin, and I haven't seen the latest number, but it may be 45,000 today with MasterCard's announcement with what they're doing. So that's a speculative bubble. You look at the SPAC, or Special Purpose Acquisition Corps, where people are being given blank checks to just go and spend wherever they want. That is creating intense pressure in the M&A market. Great for sellers, but if you own a company that is counting on consistently doing M&A as part of their growth profile or growth algorithm, they're going to be challenged because returns are being pushed down. You look at the jump in first day IPOs, 40% this year has been the average jump. To me, that's a very frothy industry. You look at the software sector, where if you don't have revenues, that's fine. If you don't have earnings, that's even better. And just crazy 1999 type valuations. And then finally, retail trading. You look at GameStop as an example, and that's the epitome of the craziness that's going on there. And on that note, we just released a blog last week about GameStop, not so much the details of that, but what it means for investors and what it means for US society. So that's something that we're more than happy to send out to anybody that's interested. All of these are concerning, and I think as a portfolio manager, you have to make sure you are avoiding these pockets of froth as best you can. Turning to the next slide, because valuation is certainly on everybody's mind, let's talk directly about valuation. Valuation levels for the US market are about 22 times 2021 earnings. That is high relative to history, I'll be the first to admit. Many people go back to 2000 and say we're almost back to the level in 2000. I'd say versus 2000, there's a huge difference though. In 2000, you could take your money out of the equity market and put it into the fixed income market and get a 6.5% yield. Today, the yield on the 10-year treasury is 115 basis points. So the alternative is not there, and I think equities remain the best game in town. You look at the slide on the right-hand side that compares valuations today in the S&P, certainly above average, but you look at an investment-grade corporate. Normally, it trades at a yield just shy of 5%. Today, it's at a 2% yield or lower. You look at the 10-year treasury, which I referenced. So these are asset classes that are more overvalued than equities, which again, in my opinion, make equities relatively attractive. Slide 8, the next slide, really does point out though, what is critical in 2021. What is absolutely critical is that we get back to earnings growth. The market performance last year was all about the PE ratio going up. It can't go up forever. The Fed was our friend. The Fed gave us low rates and free money, and therefore asset prices appreciated. We need that bottom orange line to start ticking up. And on that point, I think a concentrated portfolio, what we do, knowing your companies, being able to find 20 great companies that have tremendous earnings growth is a great opportunity, a great way to invest. So with that, let's turn to the next slide. And the next slide is our portfolio. The best thing about a 20 stock portfolio is I can show you everything that we own on one piece of paper. What you see here is we break down our portfolio, and I think about our portfolio in 3 buckets. There's the 10 to 12% earnings growth bucket over the next 5 years. There's the 12 to 15% bucket and the 15 to 20% bucket. I use this chart and think about the portfolio as a steering wheel. And if I'm really worried about the economic environment and I want to be in the bunker and the most defensive companies I can find, I turn the steering wheel a little bit to the left, and I'd have a lot more in that first category. By our positioning, you can see that I'm very encouraged about what's going to go on in the US market. And I want to find those companies that are going to participate in the economic rebound and really post very strong earnings results over the next few years. The other thing that should jump out at you is there are a bunch of very familiar names that everybody would know, and that's probably ADP. Maybe you get your check from ADP or Google or MasterCard or Microsoft. But then there are a bunch of companies that people have never heard of, whether it's an Amphenol, whether it's a Stericycle, whether it's an Allegion, whether it's an IQVIA, whether it's an Aptiv. And quite frankly, that's our secret sauce, which is finding today's great, well-known growth stars as well as tomorrow's great growth stars. So more than happy to take any questions about any part of the portfolio. But one other aspect that I do want to talk about is on the next slide, and that's what we do relative to ESG. And to me, ESG is not a nice to have, oh, isn't this wonderful? It's certainly not about exclusions, because when we think about exclusions, that is a really fast or easy way to underperform. What it's all about is assessing risk, assessing opportunities, and both of those driving alpha generation. We have been doing this for years and years. It certainly has not been called ESG, but our gut question that we ask about every single investment is, do we want to be in this business with these people? In this business is all about environmental and social issues, and with these people is all about the governance side. So how do we do it? If you turn to the next slide, there are two ways to do it. One is you can do all kinds of research, but research in itself, unless you're engaging, means nothing. So what we're doing is we're doing the research, we're using some third parties, but we do a whole lot of our own work because, quite frankly, many of the third party work is superficial. But once we have our conclusions, then we want to meet with the management teams. We want to discuss this all the way up from someone that is responsible for ESG all the way up to the CEO level. And by repeated conversations, repeated engagements, that's how we create impact, and that's how we change things. And quite frankly, as a company gets better and changes their philosophy, improves on areas that they're lacking, that's how we're going to be driving alpha. And at the end of the day, that's what's most important. Why do we have a great seat at the portfolio, at the table with our portfolio? It's because we're long-term investors. I have a team of people that have been doing this for more than 2 decades on average. And we have very large positions in the 20 companies that we own. So we do have those engagements and that great seat at the table. And if you look at the next slide really is our report card. And again, across a 20 stock portfolio in 2020, we had 60 different ESG engagements across our 20 companies. So on average, 3 engagements per company. And we discussed 89 different topics. And last year, our 2 really big topics were on the environment and having every single company get better on the carbon emission side, no matter where they were. If they were doing nothing, we wanted to have them take a step forward. If they were doing a lot, we wanted them to get even better. An example of that would be MasterCard. And MasterCard had a goal of about a 20-25% reduction in scope 1, 2, and 3 emissions over a 5-year period. They had already achieved that by year 2. And we pressed them to create a more ambitious goal, take the next step forward. And just last week they announced, and I'm not taking full credit for this by any means, I do think it's a mosaic and sort of water dripping on the rock, but at the same time they announced a carbon neutral or zero net carbon goal for 2050. So it's certainly out there, but moving in the right direction. And then on the social side and human capital development, our big focus last year was every one of our companies, we wanted them to report data into the Bloomberg Gender Equality Index. The first step on any of this is measurement. And when they report the data, that gives us a chance to evaluate where they are. And we had really nice progress there with Nike and Ulta Beauty, both now reporting for the first time and being included in the Bloomberg Gender Equality Index. So ESG is something that's incredibly important. And again, for those that are interested, we do have sustainability reports and all our engagements that we're more than happy to get to anybody that's interested. And then turning to the next slide is our performance. And we're pleased with our performance. I'm probably more pleased with the consistency of the performance in terms of beating the benchmark across all periods shown. And as Thomas said, this is a strategy that goes back 45 years. So there's certainly, there's a lot of data here. And I've been with the strategy more than 20 years at this point. One other thing that I want to mention about our strategy, because I think it's incredibly important, we have, and you look at the next slide, we have a particular performance pattern. And that pattern is keeping up, if not performing a little bit better in good markets, but really distinguishing ourselves in bad markets. So the chart on the left-hand side shows our performance versus both the S&P 500 and the Russell 1000 growth in times where both of those indices have gone down. And you see our alpha or our outperformance is very significant in tough markets. That is part and parcel of what we're trying to do. Owning great quality companies with great management teams, with rock solid balance sheets provides that downside capture. So for those that are a little bit worried about where the market is today, and maybe it's a little bit frothy, our strategy offers a little bit of downside protection while participating if the market continues to run. So I think it's a timely point for what we do. And you look at the power of compounding, which is shown on the right-hand side of the page. The power of compounding is one of those wonderful things. And if you keep on outperforming by a little bit each and every year, the performance differential over time becomes spectacular. And then just tying all this together on the next slide, the real big takeaway here is the far right-hand chart. And I think that as everybody thinks about a recovering economy and what kind of stocks are going to work, I'll be the first to raise my hand that maybe more economically sensitive stocks are going to perform well, and maybe the big tech companies might lag here a little bit. You look at that Morningstar style box and what we do, we are right at the edge of core and growth, which I think gives us a really good chance to participate in the economic recovery that we're expecting, as opposed to being stuck out at the giant and high growth bucket. So our ability to move around and shift the portfolio, I think, positions us incredibly well for 2021. So with that, let me stop and pleased to take any of the questions you all have.
So first of all, thank you very much, Jim, for this insights. Great presentation, straight to the point. Are there any questions for Jim? And following his presentation, so feel free to type your questions here down in the Zoom window. Use the Q&A function. So let's see what we have here for Jim. You also own Google, Facebook, and Microsoft. What do you think of the current valuations of technology stocks?
Certainly. When I look at Microsoft, I think it's very, very attractive. What they're able to do, the shift to working in dual work environments, meaning at the office and at home, is going to be a long-term driver of their business. Satya Nadella has truly changed the culture at that firm. So that's our biggest single weighting in the portfolio at about 9%, 9.25%. And I remain very bullish on Microsoft. You look at Facebook and Google, I think that they're underappreciated for what they do. They have multiples in the low to mid 20s on 2021 earnings, and I think those are attractive. That said, where we're scared is when you look at the software space more broadly. You have a lot of companies that don't make any money, and those stocks have quadrupled from the market bottom in March. So I think the software space, particularly where those companies are not making any money, platform companies are probably overvalued relative to much of what we own.
So there's currently a lot of discussion going on about the US stimulus package. What impact will it have on the stock market and on your opinion on the stocks?
I think the stimulus package, as I mentioned, at $1.9 trillion, maybe it all doesn't get passed. Maybe it gets watered down to only $1.5 trillion. That's a huge percentage. That's 7.5% of US GDP. That will cause the economy to boom, which again is why the portfolio is positioned and having a little bit more exposure to economically sensitive or rebound type companies. And I think that will be the more interesting part of the market in 2021.
So, and maybe a last question for Jim. So, yeah, this one here. On which areas will the new Democratic administration have a positive impact? So do you see any industries, for example, that will benefit from the new government?
I think the green initiative is something we all have to take a look at. And will there be a negative influence on the energy market overall and a positive influence elsewhere? We certainly are seeing that with electric vehicles, and that market could not be on fire anymore. Hopefully the market, not the cars. but I think that's an opportunity. And you look at infrastructure, and there certainly could be an opportunity there. That said, our philosophy is all about finding great companies bottoms up and not being too influenced by the short-term machinations of government, because they come and they go, and there might be a new Senate in 2022, and there might be a new administration in 2024. If we find companies that have tremendous tailwinds behind them driving their business, we're going to do well regardless of what the political environment is. And that's 100% what we're trying to do.
So this was Jim Tierney, Chief Investment Officer at Alliance Bernstein. Thank you very much, Jim, for being with us today and sharing your insights.
Thank you, everybody.
So we're coming to our next speaker. Dr. Christian Funke is managing partner, founder, and fund manager at Source for Alpha. Source for Alpha and Christian, they are adding the German perspective on the US equity market. They are following a systematic investment approach, and their US long strategy has been around for nearly 10 years now. They have generated an impressive performance in 2019 and 2020. They had been amongst the first percentile in their Morningstar peer group. So yeah, 2020 was a clear year for growth, but how about 2021? So growth versus value, this is the big question that is keeping the markets busy currently. So is it time again for value stocks, Christian?
Well, thank you, Thomas. Thank you, everyone who's watching. It's a great pleasure to be here and to give our opinion on the value versus growth debate and what may be interesting for this year. It's a great setup that Jim Tierney gave us in terms of setting it into perspective. So I can maybe add some further thought to that debate and to our opinions on how to time it, because we're in an unprecedented times of quantitative easing and fiscal stimulus. So my question is whether it's time to invest in US value stocks, and I'll add our opinion on that. Just because most of you, I'm assuming, haven't heard of Source for Alpha, we're slightly smaller than Alliance Bernstein. We're an independent and asset and wealth management firm based out of Frankfurt, Germany. We've been in existence since 2010, so for 10 years now, founded by myself and a couple of partners. We currently manage about 420, now it's 440 million euros assets under management. And our key differentiator is our orientation towards academic research findings in our investment strategies. So I'm going to try to take the 25 minutes that I have to give you an idea, how do we do this? How is this our USP, and how does this differentiate us from maybe some other investment approaches? And in order to do that, I'll just give you a quick idea of what is our DNA. Our DNA is this academically founded investment process. So we try to come from academic research findings out of the top journals, mostly US based, so like Journal of Finance, Journal of Financial and Quantitative Analysis, or Journal of Financial Economics. So we gain a lot of academic research insights and use this to find and understand the functioning of capital markets. We transfer that into systematic investment strategies. So our approach is a little bit different to the one we've just heard about. It's very much about systematic approaches, less about a focus on individual companies. And we see our added value in explaining what types of stocks work in different environments and when to engage in certain pockets of the market. So I'll be spending a lot of time telling you what types of the market should you be in at one point of time. And that is the idea that we follow in our US value investment strategy as well. So what's the starting point? I have a couple of points to add, but basically we've heard most of it already from Jim, and all of you have experienced it. We have a long-lasting boom over the last 10 years in value stocks, and this is a boom that has happened despite major crises, all the debt crisis that we've had, trade war 2018, or the recent Corona crash and pandemic. So we have significant turbulence, but we've had quite a boom. And the drivers of this boom, as we've just discussed, are the big tech stocks. So the big 5 of the S&P 500, we've heard the names: Apple, Microsoft, Amazon, Google, Facebook, and now recently Tesla. That's the big 6, 25% of the S&P 500. That's the stocks driving the market. Now, the recent crash, this outperformance by the growth pocket has been actually kind of supercharged. But what has happened at the same time is the government response is extensive QE. This is obviously the Fed in the US, but the same all around the world. Now, if you look into capital market research actually shows investors should focus value stocks in the times of such a monetary easing period, like the current QE program. So maybe this will give us an idea of why investors should considering positioning themselves differently going forward, especially now into 2021, given the expected economic recovery. So what are the benefits that value stocks provide in such a market environment? What does capital market research tell us? Well, there's 3 factors that are at play. Some of it we've discussed already. Point 1 is liquidity premiums. We have a liquidity premium that has jumped very high in March 2020, and then a normalization brings it back down. And this normalization is obviously boosted by expansionary central bank policy. So a reduction in liquidity premiums should favor more illiquid value stocks. Same, second point, time varying risk premiums. You have an extreme risk aversion. The volatility index has jumped up extremely in March 2020. Now it's been coming down, but still it's elevated above 20, and reducing volatility, reducing risk premiums should favor shunned value stocks. The third point is macroeconomic sensitivity. Value stocks are very well poised to recover, to have a positive reaction given improving economic outlook. So in the end, overall, we have expansionary central bank policy in the wake of the pandemic, and this should favor all 3 premiums that are inherent in the stock market and that are now steadily being eroded. So value stocks show, and historically that can be shown, a significant outperformance. I'll give you a quick overview of that as well. So here's a summary of our main arguments. We'll send you the presentation afterwards. Feel free to dig in more detail, and any questions I can direct you to the research and to our own results on that. So those 3 factors are really the key things that we think should be driving the markets, especially in 2021. The liquidity premium, value stocks more illiquid than the rest of the markets, increase in liquidity due to monetary policy injection, QE programs continuing in 2021 should help these illiquid companies outperform on average. It's actually, and I'll show you, something that we've seen in the past and that has already started happening. Time varying risk premiums. Value stocks have often reacted very, very strongly, and that exact same pattern has repeated in the Corona crisis. Now, uncertainty extremely high, uncertainty reducing due to expansionary central bank policy, but also fiscal policy, all the types of stimulus that we've been talking and that has been discussed and will come in increased form under Joe Biden as new president. So again, this should help value stocks, that uncertainty will be reduced and they will recover. And that same idea will happen with the growth that we're expecting. We've heard the numbers from Jim already. If we're expecting a very, very good economic outlook and recovery, maybe even faster economic opening than everyone expects in the US, the valuation of value stocks depends very much on macroeconomic uncertainty, because their cash flows is about the near future. Now, if the economy is being reopened faster than we think, and we currently maybe talk about, this should be actually favoring all those value stocks, which are very, very positioned very well for such a recovery, because they're very sensitive to the macroeconomic environment, and this is about the next couple of years. So a positive macroeconomic effect of QE, of economic expansion caused by fiscal stimulus, etc., this should all result in an outperformance of value stocks. So we have expensive central bank policy leading us to reduction in time varying risk premia and liquidity premia, together with the improving macroeconomic output. We think it's very good to position in the right part of the market and pick the right value stock to recover, and maybe switch away from the growth stocks that have driven the market in the last years. Now I bring you some data as well. So what is this advantage of value stocks historically? We look here in this chart at the historic QE programs in the United States. So QE1 from December 2008 till April 2010 is the first QE program. And it's always a comparison of two indices. It's the S&P 500 Pure Value Index, and it's the S&P 500 itself. The Pure Value Index, some of you may know it. It's a value subsample of the S&P 500 itself. Dramatic outperformance in the recovery following the financial crisis during the QE program. Then you see on the right-hand side, the post-QE1, let's call it an intermediate phase. That was quite short, actually, between QE1 and QE2, from April 2010 until November 2010. Both indices not quite different, but value stocks were slightly worse than the total market. QE2 was from November 2010 until July 2011. Pure Value Index 16.6% versus 8% in the S&P 500. Again, we have an intermediate phase. Pure Value slightly behind the S&P 500, and the third QE program from September 2012 until November 2014, the longest one, again had an outperformance of the value pocket of the market, 77% return versus 49% return. So you can see always the left side has the outperformance of value versus the total market. The right side, when there's no QE, no quantitative easing, the Fed is not buying any bonds, then we have an underperformance of value. And now is the interesting part, especially dramatic in the time after the last QE program, measured here from November 2014 until March 2020. So until the Corona crash hit, we have a dramatic outperformance of the S&P 500. That is the boom we've been talking about. That's the boom of the growth stocks, especially driven by the big five, big six, the big highly valued tech growth stocks. So we see empirically, plus theoretically, all the research, all the data positions us and shows us that value stocks should be profiting from expansionary central policy. And we are in a phase of such an expansion. So knowing that, having that in mind, it was actually advisable to position for a recovery, actually starting already last year, post the crash in end of March 2020 in value stocks, and to gain this recovery. And this should actually continue in 2021. This is supercharged in a way by another argument that I would bring to bear, which is that counter-cyclical stocks have a special advantage right after a market crash. So in general, we have findings, again, from capital market research, that loser stocks, simply defined by past returns, so the classic momentum effect, underperform the market. That's something we know. Empirical research shows that. Our own data shows that. When you'll get the presentation, you'll see it. I've included a slide in the appendix just for the S&P 500. However, this negative return forecast for loser stocks does not really apply after a market crash, because we know from research that loser stocks actually outperform significantly after a crash. This is exactly due to the effects described. You have this extreme risk premium that happens, and then a reduction and a recovery. So a normalization of temporarily inflated risk and liquidity premiums. And I've brought you the examples from the last 20 years on the right-hand side in this exemplary analysis of 10 quarters of minus 10% or less S&P 500 return. So the quarterly return, any quarterly return in the S&P 500 below minus 10. So we have examples, 9/11, the Iraq war, the financial crisis, the debt crisis, the trade war in 2018, or the pandemic. And you see in each of these quarters, in the first data column, you see the S&P 500 return. So going back to the first quarter of 2020, almost 20% loss in that first quarter in the S&P 500. And then the last three data columns, you see the next 6-month average return of S&P 500 stocks sorted by their previous quarterly return. So what were the winners and what were the losers in this crash? What were the pockets of the market that were really, really losing? Were the worst performing 100 stocks in the S&P 500 and the best performing 100 stocks in the S&P 500. And you'll see here, I'll just take that example of the Corona crash. 34% losers gained over the next 6 months. So this is Q2 and Q3 2020, while the winners of that crash, the best performing stock in the downturn, had a 24% return. So this is a 10% outperformance. Actually, we've sent this presentation around to our clients in March 2020, advising everyone this is a type of thing you should be considering, and this is how you should be positioning the portfolio. This is actually how we do position ourselves in our live strategies. If you go a bit back in history, that we did the same after the crash in the last quarter of 2018. If you remember back, the trade war, macroeconomic uncertainty in the US, we had 13.5% drawdown in the S&P 500 in the last quarter 2018, and then following the next 6 months, we have an outperformance of the losers. It is not always as stark as it was after the financial crisis. Obviously, if you look back at the extremes in this sample, the extreme is financial crisis, first quarter 2009. Everyone who's been in the markets will full well remember this was extreme. So after a 22% S&P 500 drawdown in 2008, another 11% drawdown in 2009 first quarter, and then an outperformance of the loser pocket of the market of counter-cyclical stocks who performed 109% plus over the next 6 months, much better than the winners of that prior quarter. So historically, on average, you should not invest in loser stocks, but they are a good turnaround investment after a large stock market crash, at least temporarily. So that's a logic. That's a logic you can apply in terms of using time varying effects and not simply positioning the portfolio, but more steering it towards certain segments of the market. This is exactly what we did. This is our performance. And as Thomas mentioned it at the introduction, this is also the reason, this time varying positioning, why we've been so well positioned in our peer group, where our stock fund, our US equity strategy, as for a US long, is rated 5 stars by Morningstar. It is in the top 1 percentile within its peer group. That's the Morningstar US value category. So both those crashes and any of those events in the past is actually a good way for us to position us in the right segment of the market, and then go back to more normalized positioning, and then again taking the right positioning if time varying premiums add up. And this allowed us to be positioned in the top of the market, achieve a return of 22.8% in 2020, 32.5% in 2019. So have a very, very high outperformance compared to the peer group of 19% 2020 and 8.5% in 2019, but also against the Russell 1000 value index. So if you're positioning yourself for macroeconomic recovery in 2021, in a time of quantitative easing, you should consider our US UCITS fund, and both its standalone performance as well as the outperformance against its peer group are a good investment going forward. If you also maybe want to complement a portfolio that has been, let's say, just by growth of the growth pocket of the markets, been steered towards a high growth rate. Even if you just have an S&P 500 ETF, you have 25% in the growth, in the big growth tech stock pocket. So maybe think about adding this as a diversifier to profit from recovery in the macroeconomy. What are you getting into your portfolio? Here's our current top 20. You see the clear value character of our fund. We have a broad diversified portfolio, usually around 50 to 70 stocks. The top 20 are clear value focus from various industries. You have healthcare, industrials, financial services, a couple of basic materials, a lot of second tier names. You will immediately see the stocks that you're expecting or that you're seeing. A lot of portfolios that have achieved stellar returns are not there. So there's no need for Apple, Amazon, Facebook, Google, etc. So it's a good diversifier. That's a lot of our clients that are interested and that are invested with us see it as another way to diversify their portfolio away from the big tech stocks and into a part of the market that should be recovering quite nicely from the coming economic recovery. And there you go. I'm happy to take any questions that you guys may have. Here are our contact details. Please feel free to contact us directly at any time, because given the time constraints, I just chose to highlight a couple of points how we do our investment strategy and what is maybe the more important reasons to invest with us right now. You have my email address and my phone number. Just give me a call. Also, my colleagues Cesar Erdogan and Moritz Noll feel happy to contact them, and they will provide you with any details that you may have if you have questions on how to invest with us. So just get in touch. I have all our fund master data here. It's a UCITS fund, can be subscribed via any platform. Just contact us, we'll help you, and you'll be sent this presentation around. So I would say at this point I'll hand over to Thomas, and we have plenty of time to discuss maybe some questions that you may have. Thank you.
So thank you very much, Christian, for this impressive presentation and showing your research and the interconnection between quantitative easing and value stocks. As you mentioned, I think this is really a big topic, and this can just be an overview within 25 minutes, but there should be more time to discuss this in deep later on. So we are open for questions. If you have any questions for Christian, type them here in Zoom. And so let's see what we have here. Yeah, this is a good one. What is the role of the portfolio manager for your systematic strategy? So I think this kind of question goes in the direction: is it a macro strategy, or is it automated, highly automated, or?
Yeah, it's a very good question actually. Our role as a fund manager is quite different maybe from the traditional role, as in the sense that our strategy obviously is very much data focused and data based. So our role is in data analysis, in improving and programming our rules, our systematic investment rules, explaining it, seeing how things have changed, doing research and directing research. So we have PhD students, we have quantitative analysis platform that we're running. So it's a lot more programming based in that sense. It is maybe less based on human interaction, in the sense that we don't talk to management of the companies that we invest in. These things are out of scope in a systematic approach. And it is obviously a lot less based on gut feel, and should be a lot more person independent. So we have 3 senior portfolio managers who are responsible for our overall US strategy, and it should be irrelevant whether it's me doing the analysis and preparing and positioning the portfolio. However, it's not fully automated. It's not an artificial intelligence or anything like that, because a lot of the decisions in the sense of how to structure everything and how to structure the rules and systems are based on research, but have to be done and are done by human beings, by us as the fund managers. Same goes for the trading of securities, for example. All of this is done by humans. So it's we let computers help us as far as they are good at, and then we take over from the point where computer technology is not far enough to fully automate all processes.
Okay, so it's not a quant strategy, highly automated, but it's just computer augmented strategy. So
yeah, it's exactly. It's systematic. It's augmented by systematic rules. It's founded in academic research and it's systematic rule-bound results. But it is still in the end a systematic approach that can be explained and detailed, but it is not fully automated bot trading, high frequency trading, or any of that. We are traditional investors, long-term investors. In that sense, we're not different to any other US equity fund. We hold positions, we shift the portfolio just as any other portfolio manager. It's just the way we arrive at decisions are maybe guided by different principles.
There's another interesting question. So how did you manage your portfolio during 2019 and 2020, which were actually years for growth stocks, not for value? So how did you behave as a portfolio manager?
Exactly. So the returns I showed you were in 2019 and 2020, but we did achieve an outperformance against the S&P 500 in each of these years, investing in a value portfolio. So, and the question is, how do you get there with a value approach? So it's this time varying nature of the portfolio. We, in 2019, right after the Q4 2018 crash, it ended on December, technically it ended on December 26th with a recovery in the S&P 500 on that day. And then following that crash, we positioned it very aggressively in turnaround stocks in the value segment of the markets, thereby achieving this 33% performance in 2019. The same happened again, unfortunately, in very short time frame, again in Q1 2020, where after the crash, we aggressively went into turnaround stocks. So this is a time when the price of risk goes up, the risk premiums are very high. This is when you should actually buy turnaround stocks. So, you know, there's this saying, it's like blood is in the water. So this is the time to buy. And obviously it's something from a gut feeling, it's hard, but if you follow a systematic approach, this is the time you can actually buy very, very attractively priced assets and then achieve an extreme outperformance in the recovery and the normalization. So the 23% performance we've achieved in 2020 is with a value portfolio, and it's come in this recovery period. So if you remember Jim's presentation from before, it's this recovery from March till September, where the non-growth side of the market has actually started behaving normally. And you can see it if you look at our fund history. The most extreme day that we've ever had is November 11, 2020. And who remembers November 11, 2020? At here in Europe, it was 12:30 Central European time, is when the announcement was by BioNTech and Pfizer that we have a working vaccine. So that was the moment of recovery. On that single day, we had a 7.5% outperformance to the S&P 500. I don't think this will be ever repeated in the future, because that was the turnaround where we knew we can overcome this pandemic. And so how did we do this? We positioned for a recovery, and we believe in a future and a normalization of everything. So that should help us also 2021 when the economy opens up.
So maybe one last question for you, Christian. Are you concerned about timing and size of the fiscal stimulus in the US?
Well, yeah, I guess everyone is. If you look at at risks, what are the upside and downside risks of the market? Obviously, there is a certain stimulus priced in, and any positive news on the size of the stimulus will drive the market up, and any negative news on it being smaller than it's currently expected has a downside risk. So I believe that there is a good probability that we'll have a decent stimulus package, although maybe there's a lot of argument that we won't even actually need it, because the economy will be opening up. And I'm with Jim on that. The economy will be opening up faster than we are currently talking about. All this doomsaying about the vaccines, I believe there'll be a lot of positive surprises in terms of the number and availability of vaccines. So we'll see the US economy opening up. We'll see a stimulus package. And let's see, maybe we'll have 2021 as a year like 2013 or 2017, when nothing big happened and a lot of positive surprises, no big risks.
So this was Dr. Christian Funke, managing partner, founder, and fund manager from Source for Alpha. Thank you very much, Christian, for being with us today and sharing your insights with us.
Thank you very much, Thomas. Thank you, everyone, for listening.
Bye, Christian.
Bye-bye.
So we are coming to our final speaker for today, and it's Charles Kantor from Neuberger Berman. Charles is managing director and senior portfolio manager. Neuberger Berman, for those of you who don't actually know them yet, they've been around for 80 years, founded in the 1930s. US asset manager, they're managing 405 billion US dollar currently. Charles is the manager of the Neuberger Berman US Equity Fund, and he will explain how the concept of economic value added helps to navigate their US equity portfolio through volatile and uncertain times. Welcome, Charles.
Thank you, everyone, and good afternoon. And so appreciate the opportunity to engage with you today, and look forward to your questions. Why don't we move forward a couple of slides? I appreciate the introduction to the firm. I'll just add that ESG, environmental, social, and governance factors are an increasingly important role that we deploy across our firm. We have a significant investment in that area, both in the US and globally. And we're a firm that if you enjoy accountability and you want the freedom to invest with your clients' precious capital, we have vast resources to bring to bear. Let's move to the slide 5, please. So let me just give you a brief overview of me and our philosophies at a high level. I've been at the firm over 20 years now. I started in management consulting in the 90s. We have a dedicated team of 8 investment analysts that are dedicated to the strategy. And then we leverage the firm's global research platform that expands 48 individuals in our equity research department. Importantly, there is no house view at Neuberger Berman. We are unencumbered to invest in businesses that we think will produce the best risk-adjusted returns for our clients, and that judgment falls to us within the mandates that we are asked to run. From a philosophy perspective, I think it's important to understand that we think and act very much with a long-term mindset. We think and act very much with a private equity-like mindset, and we fundamentally don't believe one can guess tomorrow, and don't try to. And we think very few get that right on a consistent basis. And what I think helps us is our focus on what we refer to as businesses that are beyond privileged and resilient, businesses that enjoy a dominant position within an industry, that have believable growth. Resiliency refers to the balance sheet primarily, the freedom to to not need to access capital markets to fund their growth is an important component for how we think about the world. And resiliency as well refers to the management team's unyielding compromises to drive long-term shareholder value. At its core, we want to own businesses and are happy to own businesses taking operating risk. We don't want to own operating risk and financial risk if possible, despite the fact of how low interest rates are. I will spend some amount of time discussing economic value added, or our framework that gives us the consistency of process to build long-term shareholder value for our clients. At its core, it's an economic approach versus an accounting approach. We don't think maximizing earnings per share over the long term drives long-term shareholder returns. And EVA thinks critically about the balance between the income statement and the balance sheet. So we like to say we balance sheet first investors. We believe credit markets lead equity markets. And we think a lot about the unit, a unit of profitability versus the unit of capital required to drive that profitability. So we like capital light businesses versus capital heavy businesses. And we'll talk more about that. The strategy that is a Morningstar 5-star strategy is very much driven, as hopefully you've picked up, by a bottom-up stock picking, know your industries, know your companies. It looks like a quality growth portfolio, and we generally run with about 40 to 50 individual holdings. Over time, we have strong opinions around what makes a company a great stock. What makes a company a great stock? We don't have strong opinions on how to make a company great, but we have strong opinions on how to make a company a great stock. And we think about those 4 pillars as financial communication as a business strategy. Companies get the shareholders they deserve, and it's a function of the decisions they've made around what they've deemed important to communicate. And the second pillar would be capital allocation, capital structure. Governance is incredibly important to us. I think we think of governance as first a world-class sounding board for the management team, and then secondarily world-class fiduciaries for us, the clients. And then lastly, aligning the organization across metrics that drive long-term shareholder value. Let's move to the next slide, please. When we design portfolios, we think of it as having 3 buckets: growth, total return, and occasionally opportunistic. At a high level, the majority of the portfolio will be in what we deem the growth bucket. Think of these as incredibly high return on capital businesses, mostly because the activities to support the growth, the investing to support the growth, all take place in the income statement, not on the balance sheet. And I'd say, as you think about the evolution of markets and you think about the evolution of earnings over the last 40 or 50 years, I'd say one of the major differences has been today's businesses and many of the companies that James referred to, whether he was talking about Microsoft or Google or Facebook, all the investing to drive future growth in those businesses take place in the income statement. It doesn't take place on the balance sheet. And I may argue that much of the earnings you see today, given the makeup of, say, the S&P 500, understates the true long-term earnings power because of that dynamic. Back 40 or 50 years ago, when you thought about earnings, I'd say those earnings were understated. Those earnings were overstated because all the investing was taking place on the balance sheet to drive revenue and growth in inventory, working capital, plant and equipment, supply chains, and the like. And all the income statements were capturing was this tiny depreciation charge. So that's the majority of the portfolio. We do like to own long duration assets that are capital intensive, but those generally sit in regulated industries where the regulators give you more than your cost of capital to take on bringing projects to market, on time and under budget. And so we own asset-intensive businesses, but as I said, what defines those are the stability of the returns of capital over time. And then finally, occasionally we're stupid enough to own businesses where we think industry structure may change, driving to higher returns on capital, or we'll own businesses that decide the path to the promised land is in running with fewer assets but higher returns. And I'm going to, and so that's the makeup of how we think about our portfolio. Let's go to the next slide, please. I don't think I'm going to spend a lot of time, I guess, on the macro outlook. I think it's been well covered by James. I would just simply say that we believe that over time, you can't control price, but you can follow earnings. And so earnings, cash flow earnings will drive price over time, but not perfectly in any one year. As we think about S&P earnings today, consensus kind of circles around $170 a share. We think it's more than reasonable to believe that the 170 will look conservative 9 to 12 months from now, driven by the factors that have been outlaid: consumer confidence, corporate confidence, fiscal stimulus, and monetary support. I think, as folks know, in the US, we're a consumer-led economy. Consumer is, drives 65% of activity through GDP. And one of the many surprises coming out of this COVID crisis is the consumer is in ridiculously good shape. Their saving rates are way higher than normal. They accumulated $1.5 trillion of savings through the first 3 quarters of last year. And rest assured, they are ready, anxious, and willing to engage in activities that are rather different than the activities that they've engaged in under the COVID environment. And so I think that will propel earnings broadly, together with on the corporate side, having survived a near-death experience. I'd say the companies that we engage with are ready to and anxious to reinvest in people, in new strategies, and are thinking much more critically about strategic factors as well. Of course, that being the degree to which tuck-in acquisitions or strategic mergers drive future growth. So I would say, as I've said before, we don't believe you can guess tomorrow. And if I was making this presentation a year ago, whether I was right or wrong had nothing to do with the framework that I would have laid out. But the nature of the rogue wave that seems to arrive on our shores every so often is, if you own the best positioned businesses, driving your portfolios hold up, and you're not trying to guess tomorrow, your portfolios tend to hold up reasonably well. The one final thought I'd leave you with as it relates to the macro is, if you entered 2020 skeptical, glass half empty, we would refer to that in the US, I think you have to leave 2020 less skeptical, because environments are around what happens when the tide goes out, what happens when the most unexpected developments occur, and how does how does the economy perform, how does society perform, how do governments perform, and I am just overwhelmed with confidence about how well we managed to get through the 2020 environment. Technology delivered, innovation delivered a vaccine in a record amount of time. And despite the very fractured nature of our government politics, regulatory and governments came together and passed an amazing amount of stimulus. And the Fed, for example, changed their mandate from one of just inflation to inflation and employment. And so I think you have to feel really good about, when tested the most, the system held and performed really well. And I think that's on average what makes us reasonable optimists, and being reasonable optimists in an economy that is driven by our factors has proven to be absolutely right on average over time. Let's go to the next slide, please. So for 2020, I think a little bit highlighted already, but it is about security selection. We do think we're entering kind of the golden age of stock picking. When you look at our performance, it's not about getting the sectors right for us. It's purely about, you know, getting the underlying companies right. But last year, there was this massive bifurcation between growth and value. Despite the 4 days where value just did unbelievably well, growth meaningfully outperformed value because quality outperformed cyclical factors on the full year. I think one of the surprises for me, certainly when I looked at this, was at the end of the year, despite all the conversation around the makeup of concentration of large companies within the S&P, small caps actually ended up outperforming the large companies. But where you were positioned certainly mattered, and the dispersion between, say, financials and technology, or energy and technology, or consumer services and financials was as wide as you could imagine. Despite the fact that we are very much bottom-up stock pickers, we think deeply about the factors that make up the portfolio, and therefore we include that on this page. But consistent with, you know, growth and value factors, that dispersion was as expected within the slowdown or the stopping of the economy. Let's move to the next page, please. So look, I think as you think about earnings for this year and next year, no doubt because of the snapback in economic activity, the earnings composition for 2021 will be driven by those industries that are most cyclical. However, I think when you think about, and we think about investing much more over a 3 to 5 year horizon than a 1 to 2 year horizon, when you look at the makeup of the earnings growth over the next 2 years, of course, it's driven by all the companies that facilitated the environment that we lived in over the last year. It's facilitated by the innovators, the growth companies, the software companies, the Googles, the Facebooks, and the Amazons of the world. And so the cyclical factor, you know, disappears on a 2 year stack basis. Let's move to the next slide, please. So I always think this is interesting. I'm not sure where everyone is located today, but to the degree that you're thinking about the US from a European lens, the bet you're making in US stocks versus those in the European index is an overweight bet on innovation, technology, and healthcare. And we show you the relative sizing of those sectors versus the Euro stock index. And when you invest in the US market, you're investing in growth, technology, and innovation in a much more dramatic way than you would find in the Euro stocks, for example. There's just more software, there's more technology, there's more innovation, and that really stands out to me as you think about the composition of different indexes. You know, I think, as you all know, Europe and developed world ex-US, you know, in total looks much more like a value index than a growth index. Let's go to the next slide, please. So, hitting on Thomas's question around economic value added or EVA, the way we think about picking securities is, how much am I paying today for the future that is yet to be delivered to me? And we think about that as the future growth value in aggregate. And the role of the analyst on my team is to think about the little gray boxes to the right of future growth value and come up with unique insights about why their knowledge of the company, their knowledge of how management is going to deploy free cash flow, their knowledge of the industry is going to drive bigger gray boxes than those that you're already paying for today? And do you have enough margin of safety to compensate you for that risk? So we think about that all the time. People forget that in stocks, you're already paying for something that's yet to deliver to you. And the question is, how big is that? And the role of our team is to analyze that. I thought I'd show you what that looks like for the S&P in aggregate, which is to say, if I buy the market today and you decide the market's the S&P, how much am I paying for the future that's yet to be delivered? And how does that feel relative to history? And of course, the beauty of running a consistent process and framework allows us to do this across any sector, any market capitalization, and of course, importantly, any company. And here we're treating the S&P as a company. Next slide, please. And when you go through the EVA framework, you start with profits and you finish with the balance sheet. And what I find so interesting about the profit margin picture of the S&P is not how high margins are, but how at every drawdown at every decline in economic activity, the profit margins of the S&P have been higher at the trough. If I showed you a business that could run their business in a way that produced higher margins at the bottom of an economic cycle, I think all things equal, I certainly would pay a lot more for that business if they could actually achieve that. And the ingenuity and the dynamic nature of the S&P has produced higher margins at each and every trough. And for me, interest rates the same, I would pay a higher multiple for that type of business. And that was again demonstrated in 2020. So that's the income statement story. That's a story of innovation and productivity and using technology to drive a much better margin structure. From the balance sheet side, on slide 13, we often, it's a little less common today, but there was this idea that all that was happening is companies were buying back stock and not investing in the business. You know, we think about investing for growth both through the lens of CapEx, but importantly R&D and acquisitions. And then on the management side, you know, what's happening with buybacks and dividends, and importantly, and fundamentally, how many dollars are going back into the company versus how many dollars are leaving the company in the form of buybacks and dividends. And over the last 11 years, on average, for every $100 of free cash flow created, $56 have gone back into the company and $44 have been distributed. And there's nothing out of line with those types of ratios. And I think in aggregate, corporate executives who we think of as capital allocators have been very balanced in both distributing cash flow back where they don't have attractive investment, and then also distributing investment dollars back into the business to drive future growth. Very balanced. Let's go to the next slide, please. And this is the important slide, I think, if you're thinking about an allocation broadly to U.S. equities. I will focus you first on the furthest right bar. And that bar tells you that if you buy the market today on $170 of earnings, and we updated these slides for today, your future growth value is 23%. Said differently, 77% of what you're paying for is current earnings, and 23% in aggregate is the future that's yet to be delivered. And then I'd ask you to cast your eyes across to the 11 years that we have this analysis, and you'll notice that for the most part, the 23% actually looks more than reasonable. And when I unfortunately or fortunately started in the industry, my start date, and this is why I started in 2000, my start date was 2000 in Neuberger Berman. So I've been here over 20 years. In 2000, you could only explain 40% of the market by capitalizing current earnings. And 60% of what you were paying for was the hope that the internet was going to make the world perfect, and the hope that Greenspan would never deliver you another business cycle. And earnings did grow from 2020 to 2010, a period where the S&P produced a 0% aggregate return, but they could never grow enough to satisfy the little gray boxes. And so back in 2020, the 19% you see, which is the, I guess, red line, you had to believe that the market could compound cash flow growth at over 19% a year to justify the valuation you were paying back then. Today, that number is 2%. And so if you're thinking about a long-term bet in the S&P, you have to believe that the aggregate nature of innovation and competitive markets can produce a 2% cash flow growth. And I will tell you, it may not seem popular, but that is incredibly modest, and would seem more than reasonable to achieve against history going back 60 years. So it's another way of saying, despite the fact that it doesn't feel it, risk premiums are still high in equities. And markets have aggregated exceptionally good returns over the last 10 years because the 2% has always been modest. And in fact, when fear was greatest in 12 and 13, you could buy the entire market believing that earnings were going to decline at a steady rate of 1% forever. So that's the framework we think about. If I was an analyst trying to examine the S&P, I would say there's nothing overly demanding about where the market's priced today. I think with that, let's just go to the next slide, please. I think let's keep going. I'll just end on the performance slide, which I think slide 17, maybe 18. That's what we've delivered in our UCITS strategy over the last 3 years. We launched the strategy in UCITS form back in 2015. It's a legacy. It's the oldest mutual fund that Neuberger's run. It was one of our first back 60 years ago. And with that, I'll be happy to take some questions.
So thank you very much, Charles, for sharing your thoughts and explaining your investment philosophy and the positive outlook for the US economy. So any questions for Charles, feel free to type them here into the Zoom window. And let's see what we have here. So is inflation coming back and will interest rates rise 2021? I think the keyword here is taper tantrum. Charles, what do you think?
I'm not very good on predicting things that on a one-year basis. But I would suggest that if you thought inflation was coming back, owning equities would be a good thing to do because, of course, earnings are nominal and a little inflation is actually pretty good for pricing power. But I don't have a clear view on that. But nothing I would be an expert in answering. A little pricing power for our companies and a little inflation would be really good.
Where do you find currently investment opportunities in the current stage? What industries, which companies are you currently buying?
Yeah, I mean, look, we didn't go into the individual names. We own a number of companies that James had highlighted. He highlighted MasterCard. We own Visa. We own any number of companies that you may not have heard of, although one of our largest positions, and we've owned it every day since it's public and it just got acquired, by S&P Global is IHS Market Info, a combination of market and IHS back 5 or 6 years ago. We own a business called Duck Creek Technologies, providing the insurance industry the ability to go to the cloud. Even the insurance industry has now decided to loosen their holding of on-premise data, and that's been a terrific investment, and actually example of something that we owned in before they went public, and then continue to own them through the IPO process. On the utility side, we've been long-term owners of Nextera, which operates in the Florida region, which is a great regulatory environment. And then, you know, we are big believers in infrastructure, and one of our longest and pretty large investment is a business called Brookfield Asset Management, where they're a global asset manager in real estate, infrastructure, hydro, you know, and the like. So that's a little flavor of some of our largest holdings.
So, and maybe one last question for you, Charles. So, what do you expect for the PE development of technology stocks? So, is there still room for expansion? We've heard a lot about Facebook, Amazon, Apple, Google, and so on.
Yeah, I mean, I think one of the things, if you go back to one of the fascinating pieces about the market is the large have continued to get large at an accelerating rate, and they continue to benefit from scale and reach, and the challenge for the active manager, and it's a challenge we face, is how do you think about those companies? And the principal challenge is, when you think of those companies, they're just fundamentally not expensive on traditional cash flow metrics. Back in 2000, I mean, candidly, almost any business traded north of 40 or 45 times earnings. And that's just not true today. There are pockets of the market that get incredibly high valuations because their growth is incredibly high and their gross margin structure is really appealing. But you can't make the argument that Google, Facebook, and the like are expensive. And I think it's because people worry about for how much longer can they grow at that rate, and they also worried about regulatory risk, as James laid out. But that's more than priced in, and so you can't make a valuation argument against them. And more broadly, candidly, valuation is never the reason stocks go down. It's always something else that drives a meaningful step down in expected earnings. And as I said earlier, as earnings go, so go the market over time. And I'd be very surprised if a couple of years from now, surprises included, you have much more earnings in the market. And the astonishing thing about what took place in the market last year is, to the surprise of many, many of the businesses we've discussed today, despite the COVID environment, have more earnings in 20 had more earnings in 20 than they had in 2019. That's not something I would have anticipated as I hid under my bed in March of 2000.
So this was Charles Kantor from Neuberger Berman. Thank you very much, Charles, for being with us here today and sharing your views and your analysis. Thank you. So we are coming to the end of our today's US equity web conference. So there was a lively interest of the participants, and this shows us that we have been right with the topic. So US equities simply make the bulk of equity portfolios, of many portfolios. Today we've heard a lot about factors influencing the markets, like rising valuations, uncertainties, but also opportunities. So I hope the presentations gave you some ideas and valuable insights for your work. I guess the 3 managers we saw today are amongst the best US equity managers in the market. So if you have any further questions or interests in the funds, please feel free to contact them and take the discussion from there directly. So at this point, a big thank you to Jim Tierney from Alliance Bernstein, Dr. Christian Funke from Source for Alpha, and Charles Kantor from Neuberger Berman. A big applause for you guys. So as always, there is more to come. If you like our web conference today, the next events are already scheduled. On March 11, we will revisit the topic of ESG. This time, there will be a main focus on ETF investing in this megatrend. And there is also our new format, the China Roundtable for Institutional Investors on February 24th. So if you're interested, go to Capitalmarket.events and register for the next topic. There's nothing else to say. Thank you very much for joining us again. And hopefully we see you again soon. Goodbye.